In 2022, the Fed raised rates 11 times. For most investors, that looked like good news. Savings accounts were finally paying something. But for investors managing serious capital, it wasn't a celebration, it was a signal.
A signal that the portfolios built over the previous decade had a structural problem.
Government bonds, dividend, equities,
buy-to-let property. The standard income playbook looked fine on paper, but investors were carrying risk. They hadn't fully priced duration risk, liquidity risk, in ways that only became obvious when rates moved. The investors who came through best weren't the most aggressive. They were the ones whose income didn't depend on what central banks decided to do next. This isn't a new idea. Pension funds, sovereign wealth endowment, they've been deploying into structured private market income for decades, capital placed into asset-backed positions with defined distribution schedules and contractual return profiles. What's changed is accessibility. Regulatory developments across Singapore, the UAE, and the Gulf have steadily lowered the entry threshold for qualified individual investors. Structures that once required institutional minimums are now within reach. A credible structure has three things. The income is contractual, not projected, not modeled. The capital is backed by a tangible asset, property, infrastructure, senior secured lending, and the documentation is transparent and legally enforceable. There's a persistent assumption that predictability and returns are in inverse proportion, that reliable income means lower upside. The institutional record doesn't support that. A defined yield, compounded consistently over 10 years, outperforms a volatile position across most realistic scenarios. Global allocations to private market assets crossed $13 trillion in 2023. That growth hasn't come from retail speculation. It's come from institutional capital, steadily increasing exposure to income that operates independently of public markets. The individual investor who accesses this space now is doing something that was functionally unavailable a decade ago. The question isn't whether this belongs in a high net worth portfolio. The question is whether you're ready to engage with it on its own terms.